When everyone is moving toward depravity, no one seems to be moving. But if someone stop, he shows up the others who is rushing on. Why? By acting on the fixed point. This is by Blaise Pascal. The true investor scarcely over and forced to sell his share, and all others time he is free to discreet and the current price quotation. He needs pay attention to and act upon only to the extent that it is suits its books and no more. So whenever he want to sell, he can sell, not based on the market fluctuation. Thus, the investor who permits himself to be stamped or unduly worried by unjust or feel market discipline in the holding is previously transformed into the basic advantage into the basic disadvantages. Usually, when he goes in this way, he may think it is a basic advantage, but that may even become a disadvantage for him. So he may think this is opportunity, but this may not be the opportunity right now. The man would be better off if its stocks had no market quotation at all, and for he would then be spared and mental agonies caused him by other persons mistaken of just judgment. The one thing I will say is when you make an investment based upon a concept, wait for it. Don't think of like the market is fluctuating and the price has been showing in the flash tag of showing in your mobile. Don't see through this and see of other people and make a decision of that. In the previous edition, I wrote that the well-being of the single most important paragraph is Graham Bentabok. I was wrong. The words may well be a single most important paragraph about investing ever written. Meet Mr. Market. In this chapter, Graham introduced a brilliant metaphor, Mr. Market. Let's say you own a private business, perhaps a restaurant, a bike shop, a yoga studio, clothing store, or a computer software consulting firm. Mr. Market is an imaginary partner in your business. Every day he knocks on your door and tells you what he thinks the business is worth. Mr. Marx's mood was unstable and his estimate the value was determined much how he feels and how much your business is doing. We normally name a number that sounds about right, but someday Mr. Market is Europea and puts a value in the business that are ridiculously high. Other days, Mr. Market is miserable and name the number that is absolutely low. Before he knocks on your door, you never know Mr. Market will be feeling. The more extreme his mood swing, the more intensely he will pressure you to trade with him. And vastly prices he comes up. Should you let either your own mood or your appraisal of what business worth be determined by the guy? Should you buy from him and when he wants sell? Should you sell them when you want to buy? So you don't consider the market as an imaginary person. The price is like imaginary thing. He will come and he will say this is the price, this is the price. You're going to believe it? No. So market is a course more than a metaphor. He is a stock market. The collective beast made up by millions of minds and usually sensible, but sometimes gidget and sometimes grim. You cannot be an intelligent investor either defensively or enterprising if you yet yourself became an emotional hostage. So when you become emotional hostage, it's a problem. Individual versus institution in this sentence. As an investor who permits himself to be stamped or unduly worried by the unjustified market decline in the holding is pervasively transforming his basic advantages into basic disadvantages. So when you became more friendly with this Mr. Market, you will make sometimes undisadvantages rather than advantages for you. What does Graham means by the investor's basic advantages? He means that listen to Mr. Market is an option, not an obligation. It's not an only option. It's not like you're mandated to listen to him. You don't have to trade with him because he wants you to do, and you don't have to let him outlook become yours. So because he says something, you should believe in it. This is not a fact. Why is that your basic advantages? Professional investors are the business maximizing the return on the portfolio they manage. They are the business of maximizing the fee on a portfolio they manage. So the person who is the stockbroker, he doesn't think you want to become wealthy. He only thinks out he get a commission out of your trade. So every trade you make, you pay a amount as commission. So he want you to pay that commission. Rather than that, he has no business with you. You are the principal and investment manager is only your agent. Agent has a different incentives and preferences they do. Institution must and institution can. Institution must answer to clients, regulators, and media. But you can answer to no one but yourself. Yeah, you don't need to answer to client regulation because you are the owner. Institute measures performance against the market annual, quarterly, monthly, weekly, daily. They don't do. They want to give monthly report, annual report, everything. But you can perform against long-term personal goals and ignore short-term market fluctuation. You think so? It's like I want to get this much in this many years, but I don't know what it will be. But I see fundamental analysis you do. That fundamental analysis will help you to do. Don't see to the technical analysis and make your investment faulty. Technical analysis should be done. You should see this price when today you're going to buy. You should know the technical analysis. That way you can say, okay, this is the average price is high, low. You can do that's it. Other than that is nothing. The what they need to do, the institution must stand strategies that diverge widely from the market and create a reputational visual risk and jeopardize management fees. They have a reputation. They want to comment on something. They want to say something every day. That's why the people will be engaged with that. But but you can be unconventional as you. You don't need to report to everyone. You can have your own life. Institution must buy and sell vast quantity, but you and small quantity. Because large institutions want to make a large profit where they have a large shareholders. So they need to show their shareholders we have done this transaction, we have saved this much tax. But you don't. Institution must pay high trading fees. You don't need to pay trading fees in bulk. You pay zero amount. That is more than enough. Institutional dodge criticism by selling stocks on which they incur big losses. And yourself, you can hold on a big losses in expectation of eventual recovery because they can have some losses in the books stating though in the financial statement, so this stock is falling on, we predict so we will go on more. We can't say because the shareholder will fuck them off, so you can't say that to them. So the investor typically sells small stocks that gets big, and but you hold formally small stocks no matter how big it is become. So institution the mind is to when you get a profit they comes out, and they will say we came out, but you don't need to came out. You can hold it. Institution keeps a little cash as possible, but you must to keep how much cash, how much cash possible you keep. Is a biggest investment is keeping cash in your hand. Institutional charge business management fees or reduction net return. But our thing is to avoid management fees entirely. What is management fees? Is managing the assets, managing their portfolio. They need to pay management board. This asset has been created. This wealth is created by this manager. So for them, the cut off 2%, 5%, 10% to be paid. This is the thing. In institutions generally trade with no regard for tax consequences, but you must trade opportunistically to minimize tax liability. So tax liability is very important. The company's institution buy more in a market high and sell more in a market low, but you buy or less only when you wish. Yeah, because when the market is high, so demand is high, they will buy more, and demand is low, they sell low, sell more and demand low. Because they know the market, they are the business of connecting with people, they are in the business of, but we are in the business of investing and earning and moving on. We are not in that what a business of trading, we are in the business of investing. As both are great, we are not speculators, we are investors. There's a great difference between it. Decades ago, institution has an edge over individuals. They would trade on lower cost and diverse more easily. They could obtain privileged access to companies, managers, and unearthly organized research beyond the reach of individual investors. These people are gone because no, they're gone. So they beyond the reach of individual. Sometimes in the old age they go and see the finance books, their data they collect, and they come up with a good data, and then they invest. Right now, such kind of traders are not there because the institution run giant portfolios. They often need buy millions of dollars worth of topical stocks to build a position big enough to make a meaningful contribution to performance. This their purchase drive up a price of stock they want or to own before they finish buying it. conservatively when they sell, the drive down the price before they can go because so they need to make profit. That's the only aim, and they need to reduce risk. That's the main objective. Individual can buy and sell nearly any stock without affecting the price at all. They are diversely, completely, and extremely low cost, with the total stock market index fund. Regulatory forms long run eliminating the selective disclosure that gives institutional informal edge. So, for example, they may come up with the stock and they will put the money. They have a huge amount of money. They want to hold that money. They will put in a stock and they will still sell the stock. Even that buying and selling won't affect the market. They know the tricks. Okay, such a kind of traders they are. Because the clients give more money to portfolio managers when markets are hot and withdraw it when the returns are poor. The professionals were compelled to buy stocks as they get more expensive and sell they get cheaper. You are free to do this opposite. Why that is a problem is when this kind of NPS, pension fund, mutual funds, people are what happened is what happening is indirectly the mutual funds. Mostly the mutual funds are the reason the share is going up. Government is saying mutual funds is the world bridge. It is going to help next India. Something they have promoted it, but they say it's risky. That's good. But what happens is most people who want to become rich, the speculators trade the companies like something. They choose based on their popularity. They are trading it and making the price earning ratio is crazy. 500, 600, 400, 300. It's not 50, 60 or 30, 40. It's huge. These kind of companies make a huge difference among. They think, okay, if you put money, you will get big. They thought so, and they put money in the mutual fund. The mutual fund is stating that we have invested in the shares. By that way, it's totally linked. So when they have been linked, it is totally booming the market. Like it's showing up the total NSA is huge, Nifty is huge. So such a way it is showing that way. So people thinking so investing in the shares is greatly opportunity and we can become super rich. But that is a problem. This is the reason why the share markets are falling in long term. 5 years. Because clients give more money to portfolio managers and markets are hot and withdraw it and with the returns are poor. The professionals are compelled to buy stocks and they get more expensive. That's more expensive sell when they're cheaper. You are free to do the opposite. Yeah, we don't need that. When you see based on your fundamental analysis, you can do it. You don't need to put on the risk free fund. You can put always in risk free, not the risk matter. Small companies generate their best returns as they grow into big companies. Many portfolio managers are forced to sell too soon because the small stock funds aren't supposed to own large stocks. You are hang on the indefinitely. Big funds regularly dump stocks on which they incur big losses. At least their clients blame them for blundering. You can hang on the losers you expect will be caught. Institutions will tend not to buy stocks that has suffered severe recent losses you can. The short term. The investment firms that ignores Mr. Market is all but certain generate returns that deviate widely from average, which will spoke clients with and withdrawing money, reducing the firm's management fees. Usually, when you do something, withdraw money, reducing the firm's managing fees is a very good thing. So, in the long term, to have any chance of outperforming a portfolio manager should be an eccentric, unconventional, and rational in the eyes of average opinion. Always be eccentric, unconditional, or rationalized. You see, what is average? You do it. The economist John Maynard Keynes wrote in 1936. However, Nates added, if he is successful, and that will only confirm the general belief in the rashness. And if the short run he is unsuccessful, which is very likely, he will not be receive such much mercy. Worldly wisdom teaches of fund managers that is a better reputation to fall conventionally that success unconditionally. So a simple matrix shows how clients compare portfolio managers' decision to the rest of the market. The managers who follows the herd of picking either good or bad stocks see the right column and likely to criticize or fire, but the clients will view the manager who stands alone picking good stock upper left and either lucky as eccentric while the unorthodox stock private loses money, they will regard as the managers and dangerous. Here is the thing. So, outcome of a decision, portfolio manager. He is a right and alone is idiosyncratic, but a right and alone with the crowd is comforting. But wrong and alone is reckless. He will be don't care. But wrong and along with the crowd is understandable. So everyone did it. Okay, we am doing that thing. So only a person idiosyncratic. That is the person who is want to be a market. That is the investor who want to be not to be comforting. Okay. Professional investors never want to be in the bottom left corner, or wrong or alone, where the clients might desert them. So they go along with the crowd, thereby minimizing the chance that their clients will never outperform, but maximizing the odds that their own fees won't be impacted. But however, don't have to cave to the kind of pressure. Markets move faster and traders became more volatile. The basic advantage of individual looms even larger. No one can fire you by buying an unpopular stock. You are free to seek value in the most obscure companies and to find hope in the darkest store. Never think that this company is not popular and not need to buy. That is not the case. Thing is, the money to be gone there in the darkest place, but the light is going to come in through the darkness. You can go it. And never think so like this company is good, this company is bad. Your ability to invest in the long term is a short term would be superpower. That's your superpower. You can outperform the professional because you don't have the handicaps of size, myopia, rigidity, comfort, and high cost. You don't have that. Your only cost is to invest in the shares, which is have opportunity cost through fundamental analysis. Other than that, you have no problem. You don't need to worry about others. To be the professional, however, you can't play their game. You must play your own game. You must put Mr. Market in the place of trading only when it's your interest, not his. So when your interest is over his interest, that is Apaka. When you make Mr. Market as his interest over your interest, then it's become a problem. How Mr. Market messes your mind, huh? Listening to Mr. Market will obliterate your individuality. And he will make you crazy. Once you begin to conform with the crowd, your mind is no longer entirely your own. So always the crowd moves on. Oh, prices increase. Oh, prices decrease. Such a way to go. If you have investing on the desert island, you would care only about the probability and consequence of your decisions. But you aren't on a desert island. So you probably also care about other people's decisions, what they think about your decisions, what they think about you. So this is a broad problem. Based upon your decision, what they think and what may think about you. The decision and you, that is a problem. Don't care of them. Put them out of you. Don't care about what they will think of my decision. I'm doing this decision is my own life I can do. Don't care who says. And what may people think of you. They may speak about you, don't worry. They can speak. It's not a problem. How to turn your basic advantage into dishonor. The great investor Charlie Munger, vice chairman of Berkshire Hathaway, until his death in 2003, liked to solve problems by inverting them. To figure out how you can succeed, think about what would take to fail. So this is the word. To figure out how you can succeed, think about what it would take to fail. So you want to succeed something. Take this. Find the ways in which you will fail. But so if you find that this way you will fail, this way you will fail, this way you will fail, you write everything by finding this I will fail in this way. No? Don't do that way, you will pass. Simple. So you list out these are the problems. If I do, I will fail. When you don't follow it, you will pass. Continuously, that's it. If an option of a cheap trading makes you feel you have an obligation to trade as often as a professional do, you will end up in the sandpaper, your money away and shacking up with a taxable. True. True. Do professional, don't come below it. In the option of diversifying cheaply, creating sense of obligation to diversity, discriminantly, you will end up owing a triple leveraged funds that uses artificial intelligence to pick social responsible lithium startup based on the southeastern Western Sahara. This is good. So when you use an artificial intelligence, what mostly it will say is Silicon Industries and lithium based ion, which is in the Southeast Asia. So, if you let the option of being able to ignore Mr. Market turn into obligation to act on every within, you will end up fighting your own ego and forgetting the importance of making structured decision. Because it will say every day new decisions. Ah, this market is going this way. This market is going this way. Don't follow that. Nothing is going to do with it. You follow your own dream. You know, whatever you do is correct. Nobel Prize-winning economist James Tobin once wrote that for the trustees of endorsement, such as the University of Charitable Foundation, the guardians of the futures, against the claim of the parent, the task is to preserve equity among generations. So there, what they're saying is, I create a company. Their idea is to value the company by listing, but their idea is to hold their holding till generations. They hold 90%. No? The generation should hold 90%. They should run the company. Rather, the 10% should be always that will make them value addition. They make them rich. That's it. Likewise, you are the guardian of your future against the claim of your present. You too must preserve equity among generations. To meet this obligation, you must distinguish between option and obligation. Otherwise, you turn into basic advantages into crippling disadvantages. Being a part of crowd feeling safer, essentially, if you are novice facing unfamiliar challenges, taking into high risk, you may tend to defer the consequences. More even decisions harder because being able to deflect blame over big mistakes feel even better. So this is a good thing. So if you start, you may tend to defer the consequences, and mere then when take decisions are harder. So you want to make hard decisions, but you may say comfort. Ah, what is going to happen? That's a problem because you're able to deflect blame over big mistake. So you think I can get the blame rather than becoming dealing with the mistake. I can. That is a problem. So when you take a step, you find out what are the problems will make you a failure. Write it down. If you don't follow, I'll pass. But when you pay attention to the same things, the same time, and other people, you will remember it's better. So when you pay attention to the same thing at the same time as other people, you will remember it better. So the attention is matters. Feel intensified emotions, make more extreme judgments, and be more motivated to act. Always you engage with it. When you engage with it, it will help you a lot. Think of the difference between watching and sporting event by yourself on a delayed video feed at home and attending in a live in stadium, even just watching in live in your phone. Yeah, if that makes you happy, it's happy. The interest in social media creates borderless communities in which thoughts, even millions, can focus together on the same topic on even. Yeah, the social media has made it possible. A single event can be viewed by many billion people and make it, and these companies are ready to use it news to squeeze your money. When everyone has seamlessly mutual access to the information, each can independently see and hear that all the paying attention to same things at the same time. In the state of shared attention, you can feel other people's mind convincing with your own. Your experience is collective. Your confidence is surging from knowing you are not alone with what to believe. You became we. So the human you became it's not you, you became we. Because you collectively you are getting same information, you are mingled with the whole media. That's a problem. Human evolved to cooperate in clans and small groups. The ability of countless people, no matter how widely disposed to coalesce into one collective mind is unpredictable in human history. Yeah, our individual brain haven't learned how to cope with it yet. Yeah, the sudden increase in people watching you continuously, it is increasing daily, day by day. But you have not coped with yet how to deal with it. That's a problem. Technology has turned Mr. Market into a monster. Mr. Market is a monster. He will is like a devil or a bad energy. He will influence like something. He'll makes you crazy. Individuals who flock to buy much mean stocks as AMC Enterprise and GameStop in 2021 exemplify the pitfalls of the phenomenon. So they know some products are to be going to waste, but as per the Mr. Monster, tell you it is going to great, it's going to go high, high, And by thinking so, you lost more of the money. Wall Street Beach online forum ends in January 2020, 1.8 million subscribers. A month later, 8.4 million. On January, the day Elon Musk tweeted GameStone, the world stock subscribe posted a astounding 352,587 comments, mostly about GameStop. In January 28, Wall Street Bets generate 271 million pages, making the third most visited website in the world of that day, behind only Google and YouTube. From its closely the price of January 21 high January 28, GameStop stock rose more than 1020%. Few people who sold at the top make money. Most hang on hope for hope. They incurred massive losses and the stock went into Kamakia dive in February, losing 69%. So people keep it boost and the top when the price goes top, they make the money and come. They know this is a peak that's more valued more. But people who invest in the top, they lose billions. With the shared attention intensifying this memory, emotion, and motivation, many still remember every twitch in the prices of the stocks, remain outraged over these losses, believe, discouragement, conspiracy theories, and refuse to sell even though their holdings have silvered before their eyes. Their holding is shattered, but they believe, based upon the conspiracy theory, this stock market, the authorities are looking into it. They're going to take action. They're going to recover your money. Nothing going to happen. This Mr. Monster will manipulate you by the way. They will lead you to delusion. Think of you're going to make money, but the truth is not. How Mr. Market misses your heart. So how Mr. Market messes with your heart. The emotion mood swings of the stock market can very quick havoc on your feelings. So mostly the market price comes and goes, you affect your feelings. Psychologists have shown that emotions shape both your perspective and our actions, creating unconscious biases that can govern our behavior even if we aren't even unaware of it. So this we won't even aware of our emotion, but based upon this market, it's effective. Even a faint whiff of emotion can sway your decisions. Anger fries your agency, confidence, and a sensation of being in control. Angry people rely more on snap judgment. Based upon judgment, they take decisions. They also think good things are more likely and bad things less likely. I think, and happens to them than to others. They think, sir, for us this is happening more, sir. For them that is happening more, sir. They think of that. Angry people, especially men, take great risk. So the speculative income mostly is taken by the angry people, and that they take more risk. Anxiety many makes you more sensitive to the magnitude of possible reward than probability of receiving it. So that makes you anxiety will come when because of this monster. Long shots bets look better when you are anxious, especially you being have been losing money, because when you took a long shot, you think from today it will going price is going to go up, but when you buy the price will go down, and that will make you anxious. That's a problem. Loneliness. You make it can make you likely to seek out information that could contract what you already believe. So you may came to a conclusion based upon your research, but the action what the market is showing is totally different. That monster will make you alone, and you can it also can increase your anxiety, impair your reasonables, and shred your attention span. So this is the main problem. It will defeat everything, and cabin fever and undetermined your self control will make you more impulsive. It will make you like a time bomb. You'll more impulsive, become anxious, you will like become crazy. That's the thing. Sadness. Many people prefer smaller rewards sooner over long reward later.
So this all these YouTube videos or everything giving a small, what happens, you can see every video something will be there, something will be happen to the hero or heroine, that they will get something. If they get something, you believe that you will get something. That's what. So even your short investment, you get a small in return, that you are happy, even you are not able to wait for a long period of time. It also can realize rise your price you are willing to pay to buy something you don't want. So that's something you are not owing, but you are like to pay the price for that. That is this big bucks. A feelings and makes riskers better bets more attractive and differing gratification more difficult. So the sadness makes them to make very grave mistakes. They think so if we make this bet everything will move up. No, nothing will happen like that. Sadness is emotional poison for patients. So the sadness is a greater poison for patients. When sadness come into a man's life, the patience will go away and you will become a patient. Stress, the impaired working memory, and makes focus on long-term goals difficult. Stress is a very great thing that you will forget everything, and you will forget every goals, and you will become stressed. It can lead to perseveration, in which people follow same failing behavior regardless of feedback. Yeah. Under stress, you might jump into conclusion and neglect novel solution to problems. A normal solution you will forget. Everything you will say is simple solution. You can come to answer. You will think complex. Stress can also trigger increased risk taking. Is it any wonder that during a COVID pandemic, and hundreds of millions of people felt angry, anxious, lonely, sad, and stressed? 10 million started importing and trading in stock. So in the COVID time, people started. They have no work, they have money, they don't know what to do. They simply start trading in accounts. I think in trading we can earn money. Such a way, Mr. Monster became great monster. Talking back to Mr. Market, today the stock market crashed more than 30%. Your phone is fratting with the news alerts, electronic stock tickers, and endless scroll of crimson. The president is arguing in public to remain calm, and television is punching and striking that everyone should sell everything. Friends and families are texting you to dump your stocks while you still can. Whether you realize it is or not, your heart is racing, your muscles are tense, your palms are sweating. Yeah, because of this Mr. Monster, everyone say this will become that, this will become that, this will not, you sell it. In such a way, this is happening. Mr. Market is a red face has to bang your door, yelling that every dollar you have in the stock yesterday is worth less than 70 cents today. So it is saying that "Hey, it's going to fall, it's going to fall." It doesn't know, how do you answer them? You have the option to sell, but the obligation to think before you act. Yeah, the market has fallen 30%. I'm not saying no, but you should think about it. Whether the decision what you go make is on your own, have you have any basis? Uh, then you do it. Go to a quiet room. Imagine that somebody else had just suffered those losses and is asking you for advice. Then should prompt you to reflect on questions like this. Other than stock price, which specific aspect of business you have changed? So the prices fall. I'm not saying no, but other than that, what is the change that happened in the business? Whether the turnover has reduced, whether bad debts has increases, whether their business has fired off people, how the company is coping up with it. Is the economic policy is different? The government policy has affected it. The climatic change is a reason for it. The political environment has been changed. Such questions you need to ask. How large tax bill would be if you incur to sell? Second question. So if I going to sell it, this may be my revenue, or this may be I need to this much amount I need to pay as tax. I'm liable for this tax. So how I'm going to do it? That's a question. The stocks or funds or gift rather than purchase, would you return it to the person who gave it to you? Now that is fallen in price. So one person has given you this stock as a gift. What are you going to do? You going to return it or you going to keep it? It's a good question because stock options. Has the stock or fund ever gone down this much before? Or if you would you have done better if you have sold out or if you have bought more? My question is whether in the history of share market This change of the stock price is a new, or it has been a repetitive act, and what is the reason behind it? You come up with the conclusion. I now rather need to sell my stock holdings in a profit, or I need to buy more. That's my question. If you like the assets well enough to buy it in higher price, shouldn't you like it to more now than price has fallen? So you have bought something in higher price. Now it has fallen. I know. If you can realize something. My question is the same price has fallen down. Will you invest more if the same thing is given in a much lesser price than the more in a higher price? That's a thought now. Such question will take some research to answer with. But as it you should be. This way, Mr. Market overactions to change the price from containing your view of underlying value. He might be right, he might be wrong. Only the comparing price against a value will able to tell. So only after comparing and seeing the fundamental analysis, price earning ratios, many ratios are there. After seeing that ratios, only you can see. You can see the some approach whether a single stocks industry or an entire market collapses. You can also involve the questions whenever prices goes up further faster they are expected. They may go up, they may come down, they may come down, they may go up. Sooner or later, the Mr. Market will go off the rails and be prepared so you can stay on your track. So, this Mr. Market, the devil, are the big make you to fear like that. No need to worry. You stand in your positions. Thank you.